Welcome to the latest Motley Fool Scoreboard. I'm on in Chalk Balloon. We've got longtime fools, Jason Hall and Nick Sciple, giving a 1 to 10 rating to Moneyball Wreck, Aritzia, ticker symbol ATZAF. Rate the strength of Aritzia's business first, including factors like industry and competition. 10 is invincible. A 1 is hopeless. Jason's at a 7. Nick, you're at an 8.
Yeah, I went 8. Retailing is a tough industry, difficult to get to a 10, but Aritzia has really carved out a niche. They call their brand positioning everyday luxury, so think about sitting in there between fast fashion and your traditional luxury brands. The business is absolutely on fire right now, just posted their first ever $1 billion quarter with net revenue up 43% in the quarter. The bull case for the business is growth in the United States. The U.S. grew revenue by 54% in the third quarter, yet there's still only 72 boutiques here in the United States. There's a long run target from Aritzia's management of over 200 stores in the U.S., which gives the company nearly a decade of growth runway in North America at their kind of 12 store opening cadence they've been operating on for the past few years. They just launched a mobile app that exceeded expectations with over 1 million downloads in the most recent quarter, driving a 58% increase in e-commerce revenue. Because they control their own brands and supply chain, they've got great agility, differentiates them from other retailers. But again, docking a couple points because fashion risk is real and because the macro environment around tariffs and consumer spending remains a potential threat to the business.
Yeah, my 7 was that last thing you mentioned. The fashion risk is real. That's the thing, and that's the difference between the 8 and the 7 for me and Nick, I think. But this is the sort of retail that gets really interesting to me. I think there's two things that I like. I like a really cheap old guard turnaround. It has to make sense. This isn't that. It's also not a cheap fashion future flame out, which we've seen lots of those. This is a proven business. It's fully integrated. Yeah, everybody uses contract manufacturers, but from design to retail, they own that. And again, it's a 40-year-old business almost at this point, but they're starting from a really small footprint. And there's a ton of clear growth ahead that doesn't just count on comps growth, but even across the brutal fashion cycles, there's a clear path to be able to continue growing this wonderful business. Like I said, it's been around for a long time, but it's still so early in its global growth story that there is a lot to like.
Yeah, usually we're talking about American companies that, maybe they can expand internationally. It's a Canadian company that can expand in the U.S. and that footprint growth and that e-commerce growth, that gets really interesting. For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Jason's at an 8. Nick's beside himself. He's at a 10.
Yeah, hard to go 10. I've only ever gone 10 once before with Mark Zuckerberg, but I think you have arguably the best management team in retail here. You've kind of got the best of both worlds. You have a visionary founder and master operator with Brian Hill, who is the executive chairman of the business, still owns just under 16% of shares outstanding and controls the company through super voting stock, remains active, guiding the brand vision and real estate strategy for the company. Then as CEO, you have Jennifer Wong, who started as a sales associate nearly 40 years ago and has worked her way up all the way to the CEO role. If you look at this team's execution, they're currently tracking to hit their fiscal 27 revenue targets a full year early. They've successfully navigated supply chain headaches and tariff pressures while actually expanding margins in 2025. 400 basis points of tariff and de minimis pressure in the most recent quarter and still expanded margins year over year. Really hard to overstate that type of execution.
So getting to a 10 is just so hard for me. Maybe I could have gone a 9 here, but I'm at an 8. Nick, I love your enthusiasm, but we're less than a decade in Aritzia's life as a public company. As a side note, I used to work with Jennifer Wong when she was a sales associate, but it was a totally different Jennifer Wong, but in my opinion, equally talented. But okay, seriously, you have everything you said. It's a dynamic duo, a founder and operator, very long tenures with the business. They have deep understanding of the business and its culture. Sometimes I don't know if we value that enough with businesses that especially ones that are growing like this and how important that culture is, but also navigating a really brutal industry. Guess what, guys? They've also made shareholders a lot of money, and we should give managements credit when they do that for us.
For financials, a 10 is a fortress, a 1 is yikes. Jason's at a 9. Nick keeps that 10 going.
Yeah, again, hard to get a 10, but you look at the most recent earnings report, and really every number remarkable. The balance sheet is pristine as of the third quarter, the most recently reported quarter, over 600 million Canadian dollars in cash and zero debt. That gives the company the ability to self-fund their U.S. store expansion and infrastructure investment, like a new distribution center they are investing in today. They're highly profitable. Margins are expanding, generating lots of free cash flow, buying back stock. Again, as I mentioned earlier, even facing tariff headwinds, they're able to grow their gross profit margins in the face of that. Rare to see a retailer growing this fast with a balance sheet this clean, delivering these type of operating results.
Yeah, I'm a little lower, but still a 9, which for an industry like this, for me to give it a 9, it says a lot. The liabilities have increased substantially since the IPO, but they've matched the growth of the retail footprint and the assets that they need. They've managed inventory extremely well. And the most important thing, and it's even more important for businesses that are growing like this, turning revenue into cash at really high rates. They do that very, very well. It's built to get through macro weakness. That's so important. And also continuing to grow larger without needing somebody else's money to pay for it.
Love that last point. Love being able to fund your own growth through your operations and cash. Jason, let's talk valuation. How well will Aritzia stock do over the next 5 years, and how safe is it? 10's a sure thing, 1's a lottery ticket.
So my safety score is a 5, and I could. There's plenty of counter cases to say that that's too low. I think 5-year returns, I think 10 to 15% annualized makes sense. And it's just because it's really expensive. You're talking about paying 4 times sales, but you start looking 5 plus, 10 plus years, that growth trajectory looks so good. I think investors are going to do really, really well. Especially if you build out a position over time. You might have to hold your nose today to start a position and then look for better opportunities. But I do think investors are going to make good money with this business.
Yeah, so I went to 15% plus 5-year returns, safety score of 6. Listen, the stock is near all-time highs, as Jason points out, trailing at more than 40 times trailing earnings. So we're not getting a bargain price, but this really is a business that's firing all cylinders with lots of runway ahead of them. Most recent quarter, 34% comp store sales growth. That's really an insane number no matter what type of company you're looking at. Brand has lots of momentum, and management has a great track record. 5 years from now, if you just do the math, opening 12 stores a year, the U.S. store base likely has grown by 80%. The brand moves from being a name that is known among kind of fashion-forward, Gen Z and millennial women to being a name that's much more of a household name. And I think 5 years from now, we're likely starting to get a foothold in Europe, start opening stores in places like London and Paris. They started to lay the groundwork for that in recent quarters, opening their international e-commerce sites. I think there's also a decent chance this stock switches to a U.S. listing in the next 5 years. The U.S. business it just switched to a majority of revenue over the past few quarters. And again, if you increase the store base by 80% over the next 5 years, you're looking at a business that is substantially U.S. focused. And I think with all that type of operational success and growth, I think the stock can double the next 5 years without multiple expansion. That gets you to a 15% plus return.
Thanks to both Nick and to Jason. They've given Aritzia an overall score of 8.1 out of 10, which means I need to own shares, but I already do. So I'll just keep holding happily. Nick has no toppets because he thinks Aritzia is the best retail story he's ever come across and one of his biggest personal holdings. High praise. Jason, though, prefers Lululemon, getting that value turnaround play, also Canadian. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Vital Farms, because you don't want to put all your stocks in one basket. Till then, Fool on.